you talk about Coca-Cola in your book, okay? And a lot of people have talked about Buffett with Coke, okay? So now let's talk about a feature or a benefit of strong moats. Historically speaking, strong moats exhibit high returns on capital or sustainable returns on capital. Okay, so let's use Coke. How do you look at Coke? You know, at least using the example used in Buffett, because I guess I have a very different view of Coke as like a 41-year-old versus I think when I talk to a lot of baby boomer PMs, they talk about Coke as this incredible investment looking back when Buffett bought it in the late 1980s. But as I fast forward for most of my adult career, it's actually been a laggard. And if you look at the returns on capital, they actually don't really tell you what's gone on in the business. And so how do you look at those kind of situations where there's a preponderance of huge investment success off of returns on capital where everyone can perceive the moat, and then you wake up 10 or 15 years later and that moat is less perceivable and therefore the returns have gone to the wayside?
Well, I'm not sure that Coca-Cola's moat is any smaller, narrower, however you define it, than it was 20 or 30 years ago. You know, it's got an incredibly powerful brand, and
agree.
You know, it's a well-run, I mean, clearly a well-run and attractive business. The problem with Coca-Cola, for me, is, you know, when I look at Coca-Cola, so I did a project for a wealth manager here, and they felt they had a lot of expertise in the UK stock market.
Okay.
But they didn't really know anything about stock markets outside the UK, and they felt that they needed to have a product for their clients, international stocks. So I built an international model portfolio for them. One of the stocks they had in their portfolio was Coca-Cola.
Okay.
And I said, well, you need to get rid of that. And they said, well, why? And I said, well, it's not healthy. You know, if you look at a stock like Coca-Cola, it's making people less healthy, more obese, and that sort of negative externality today, or when I looked at it, didn't have a cost. But I said, well, you know, over time, this will have an increasing cost because every Western country has got an aging population. And what happens in an aging population? You have more healthcare costs.
Sure.
And you've got, you know, we've got an aging demographic, fewer young people working, more old people in the, you know, taking medical aid in the National Health Service in the UK.
Sure.
And there's Coca-Cola has got a very high externality cost, and therefore I think that cost is going to be a bigger risk for it going forward in time. And I said, I can't remember what the valuation was at the time, but you know, it's not that cheap. And how's it going to grow? You know, it's already got a very, very high penetration.
Sure.
So, you know, I think Coca-Cola is well managed, and they've done, you know, clever things about broadening their product range and so forth. But to me, it wasn't a stock that a wealth manager should be recommending for their private clients to have in their portfolio and own for 10 or 20 years because of those issues.
Sure.
Now, does that mean it's got less of a moat? When we think about the moat, that externality doesn't really factor in. So, you know, all I'm trying to say is a moat is useful, but you've got to look at the total picture.
Sure.
And I'm very wary, particularly, you know, when I'm thinking about doing long-term investing, which wasn't my specialty when I was at the hedge funds. But when you're doing these long-term investments, I think you've got to really factor in how those sorts of things may change.
Sure.
Because those are the sorts of things that come from left field, sometimes very explosively and spectacularly, more often gradually, and they just erode your valuation.
Sure.
So you see the valuation shrink over time.
Well, yeah, because when Buffett originally bought it, it was producing like 25% return on equity. that then jumped up as like the German, the Berlin Wall fell in '89, and the emerging markets of the world expanded massively as a customer. So it went to 50%. And so I always point out to people like Buffett made incredible money from a 10-year perspective. And then I don't remember this, but he talked about Coke and Gillette as the inevitables, right? It's just inevitable that they're going to be the ubiquitous product in their category. We'll call that a wide moat, in our parlance that we're using here. And it was like the kiss of death, because if you look since like 98, I think Coke's produced a single-digit return, even though, to your point, it's had a strong moat, it's produced high returns, they bought back stock, etc. And to your point, I think it can show that you can take an incredibly high moat business like Coca-Cola, and you could take high returns, and you could take what could be okay capital allocation, and you can still take a security that over 20 years does terrible for volatile common stock risk. And I think that's something that, especially with the era we're coming out of, most people are like, oh, it's high, it's a great mode, it's high returns, I'm going to make money. And it's like, that's not why the stock market was formed. It wasn't formed to find those two things and get rich. Like that's not the point. It's now, are there times that can do that more often than not? Yes. I want to pivot a little bit. So insiders, you talk about insider buying. I also love it because you're like going through a bunch of my hit list of like people I've followed. So you talk about like Mark Dixon, IWG. Full disclosure, we used to own it. I got tired of watching Mark take margin calls, which also you commented on your book in that. I think the last iteration of the margin call is like, that's it. If he can't to run his own personal balance sheet appropriately, I'm just kind of done with this. Because if he can't do his personal balance sheet, how can he run his corporate balance sheet? But then you also mentioned like Lord Simon Wolfson, who's, obviously an incredible capital allocator at Next. We own Next. How do you think about insiders like them, in both in transaction form, but also ownership form as you analyze investments?
Well, I think, directors' dealings, I think, are slightly dangerous because I think people follow them blindly.
Sure.
And, the most dangerous thing is you get the chief marketing officer buys a stock after it's been cut in half and nobody else does. And he's never bought a stock before and he doesn't actually have a clue what he's doing. He doesn't understand investing and, the thing carries on falling. I like to see, more than one director buying.
Sure.
I like to see them all, all believing in it because then it's much more likely to be right. But, if you've got genius capital allocators, genius managers like Lord Wolfson, or my favorite is Michael O'Leary at Ryanair. You've got to be quite careful. Michael O'Leary sold shares every single year. And I said to him, Michael, why are you selling shares? What are you buying with the shares? Was actually why I asked him. And he said, I'm buying gilts. And what he was doing was he was de-risking his portfolio. And although Ryanair has been an incredible investment, he was buying gilts and made quite a lot of money out of zero risk government securities.
Sure.
So, I think it's quite easy to identify now that Michael O'Leary is a genius. It was actually quite easy 20 years ago. I mean, I tell this fantastic story about, I used to do transport. So I initiated in Ryanair with a sell recommendation. And I sent the draft of my note to the company, to O'Leary for comments.
Okay.
And he sent a fax back. I don't know why he didn't like to use email, but he sent a fax back saying, Steve, thanks for your note. You're wrong. And we'll prove you wrong, and good luck, And
by the way, I love that. I totally, we want the ball because we're going to score and win the game, and we'll see you later.
Yeah, no, absolutely. And the stock fell by 40%, and I upgraded from a sell to hold, and I emailed him, and I can't remember what he said. He writes the most funny letters. So he said something about, well, how long will it be before it's a buy, sort of thing,
Yeah.